Good morning, everyone. This is Stuart. I hope you had a good weekend. Unfortunately, a turbulent start to the week in markets again. This week, wanted to quickly cover evolving tariff risks, the latest on the economy, the S&P 500 sell-off and current valuations, a quick note on interest rates, and then a brief update on energy and artificial intelligence. Quick disclosure, investing involves risk. Past performance is no guarantee of future results. All right, so the big news over the weekend was that Trump's economic advisor, Peter Navarro, said in an interview that the administration is going to implement tariffs that will raise 6 trillion over the next decade. How do you get to that number? US imports in 2024 were just north of 4 trillion. If you slap a 15% tariff on all imports across the board, you end up with about 600 billion in annual tariffs. Now, it's important to note that's assuming a static world where US consumers and exporters into the US don't change their behavior when these tariffs get implemented. I think that's unlikely. And as the tariffs take effect, supposedly on April 2nd later this week, we're going to see changes in consumer behavior, and our trade partners might look to trade elsewhere. What impact is this having on the economy? It's tough to say right now. Obviously, the uncertainty around tariffs is causing businesses probably to hit the pause button on near-term plans. We are seeing from the Atlanta Fed, which tracks real-time GDP, a deterioration in first quarter GDP estimates. So according to the Atlanta Fed, GDP might be as low as -3% for Q1. When you adjust for gold imports, we're down closer to -1%. Earnings revisions for S&P 500 companies have been negative. This is just looking at companies giving lower revisions versus those giving upward guidance. This is the lowest this measure has been in the last 4 years since COVID. And the S&P 500, as of this morning, is back into correction territory. As of this recording, it's actually down a bit lower, below 5,500 level. So we're off 10% from recent highs. Again, the severity of this sell-off is notable in the speed. The magnitude does not yet compare, and hopefully it won't, to the 2022 sell-off that we saw when the Fed started raising interest rates. The forward PE ratio of the S&P is down after this latest correction. We went from about 25 times earnings to closer to 21. Notable that over the last 40 years or so, the average multiple, the forward average multiple on the S&P is closer to 18. So if we do have multiple reversion back to the average, we're still looking at scope for more downside. Interest rates, U.S. Treasuries are getting a bid. There's at the beginning of the year, the 10-year Treasury was closer to 475. We're now back to about 420 on the 10-year. Any signs of economic weakness are likely to get a bid for Treasuries. But on the other hand, we do have this emerging inflation risk if these tariffs get implemented and we get some sort of price shock, and it's going to be a tug and pull on rates. In terms of investing in rates, we feel a bit more comfortable in shorter duration because the long end of the Treasury curve could see a sell-off if inflation risks get out of hand. Year-to-date laggards and valuations and leaders. Energy stands out as a leader in price performance. The energy component of the S&P 500 is up 9% year to date, and it also stands out as having a pretty reasonable valuation at 15 times forward earnings. As the Trump administration considers tariffs on countries that import Venezuelan and even Russian oil, that is giving a bid to energy prices right now. And as we've talked about in previous updates, natural gas stands to benefit from demand due to the international liquefied natural gas trade, or LNG, and also demand tied to artificial intelligence uses. And on the last note, just a quick update. Last week, we talked about a new feature in ChatGPT that let you make fun images. Well, that really caught on like wildfire. And Sam Altman, who runs OpenAI, said that their GPUs are literally melting. If you use the service, it's pretty notable how much demand that photo feature is using. Queries that used to take 10, 15 seconds now take up to a minute or two. So there's been a concern in AI that perhaps there's been overinvestment in GPUs. I think as the use cases for artificial intelligence continue gaining traction, that concern might fade away a bit. But what is concerning, at least in the near term, is that if we get any sort of economic retrenchment, it's going to be awfully hard for the Amazons, Microsofts, Googles of the world to probably spend the hundreds of billions of dollars of capex that they've remained committed to. They'll likely respond to shareholder pressures in the near term on that. So just something to watch going forward. If you have any questions, please feel free to reach out to us. We understand it's a volatile period in markets and are there to help you through it. Thank you very much. Hope you have a great morning.